Hi everyone, thanks for having Neutral here. I'm here to speak about the actual highest form of scalable yield you'll see on chain in the next few weeks. Currently, most, LP providers, curators here, prop funds, liquid traders realize that most yield in the space on a delta-neutral level is actually quite cyclical. It really depends on how much leverage is in the system, and a lot of it is actually capacity constrained. What do I mean by that? So you often see a new protocol come out or somebody doing liquid basis, and largely over a couple months, once actually incentives are gone and token emissions, the yield leaves and it's non-sticky, and actual big providers move on to the next type of protocol or product to farm. What we're doing is actually bringing on-chain for the first time a type of yield that has never been available to either open up to other funds or retail. It's been run by the best market makers and funds in the space. It basically works on the price dislocation between crypto private markets and spot markets that currently exist. If you're similar and if you know about Athena, so Guy is one of our early investors, and largely what we do is we basically buy tokens from foundations like Avax, Solana, Sui, etc. at discounts between 20 and 50% on the spot. And then the perp price is up here, and at that point we can actually then hedge out this exposure on Binance, Bybit, OKX, etc. And over time, this pays out yield, which is real yield, not token emissions. It's yield that actually is dollar cash. Yeah. So basically what will happen, similar to how Athena works, is a user comes to us, they deposit stablecoin, USDC, USDT, USDE. You'll mint NUSD, which is basically a wrapper on this tokenized yield fund, and you'll lock up for certain periods and you get paid back the cash. Right now, I think most of us are in the fund space, so you can decide on how you work at the capacity here. But largely, I think the next 1 year we'll be at a $3 billion AUM TVL, and it's largely because of the funds who've already invested in us and the actual scalable yield that's possible. Here's some actual alpha that most people don't know or can't see. This actually explains the OTC price. So price of foundation A to J sold their tokens over to us over the last year. So the dark green line is actually the already discounted price from spot at that time, whether it was on Binance, Bybit, OKX. And 1.5 years later, the lighter green line is where the actual token is trading. So it's from the discounted amount, it's already way below that. That's what makes the strategy even safer. You go straight into cash as the short starts printing. Another key thing that's happening over the next 2 years is highly liquid, multi-venue tokens are seeing the highest unlocks in the space. So there's going to be a lot of token emissions that actually come out, which actually drives OTC supply. So in the next 2 years, we'll see $55 billion of OTC supply. This is why foundations actually start selling their tokens at a discount in the market. These were returns last year, pre-neutral, when we ran it. So the lighter is actually the full return on the OTC kicker, but the darker line, if you look at liquid basis, right? If you look at things like that exist right now, like Athena, etc., they run liquid basis, Delta-Neutral on Ethereum and Bitcoin. This is if you ran it on a basket of other type of tokens. Often altcoins have higher liquid basis, but at some points they're negative. But if you did the OTC kicker and ran it on the bottom, you see the return is much higher Delta-Neutral. I'll give you a live example. One of them was Avax. So Avax, if you ran normal liquid basis Delta-Neutral, it was about 28% last year. If you did the OTC deal that was on offer, 9-figure plus, it returned 114% in 6 months. So currently we're in private beta. We're running just over 50 mil at the moment. We're generating 30% APR to our LPs. We wanted to start it this way because I think most protocols just start and then people come in deposits and then you figure out whether it works. We want to show people that it actually does work and they will get paid back over time. We'll be public in the next 2 weeks across Morpho, Euler, Pendle, Plasma, etc. So why does this work? This trade is not rocket science. I'm not coming out here to say I'm the smartest guy in the room. Largely is I've hired guys that worked at market makers. We've done this stuff before at some of the biggest names in the space, and we decided to build out our own product. But the biggest thing here is supply. So one of our lead investors is doing the most OTC supply in the space right now. They work with a lot of foundations and teams, and this is how we're able to source. The rest of my team now directly also source from foundations just from doing the trade previously at our other jobs in the space. It's very institutional, like risk management. We work with the best custodians in the space, Fireblocks, Copper, Sifu. We should onboard onto Anchorage at some point. And then we run everything off exchange settlement, so the funds are actually safe and they're not sitting on exchanges in case of any bankruptcies there. Realistically, why does this work? So current spot markets, like if you just had a token on Binance, Bybit, OKX, and you want to sell it, there's not enough liquidity when you're doing things that size. But perpetual markets, so I think the three best innovations coming out as a trader in the space over the last 4 years has been perpetual swaps, because they do about 7 to 8 times actual volume of the spot underlying right now, allows you to hedge out these type of exposures. Stable coins that exist will provide collateral and yield-bearing tokens, similar to what neutral NUSD will be, and other type of venues and trading tools that are way better in the space now. OTC profits under various type of conditions. What do I mean by that? So if you run liquid bases, and I'm sure most of you do on fund spaces, right now it's actually pretty low. I think DeFi yields are probably at the lowest it's been in about a year or so, averaging around 5 to 6%. By having the tokens already given to us or purchased at a discount and in our custody, as these unwind, it just provides a much higher amount of return. These are actual real deals that no one has seen. They're not public yet. There will be a dashboard. It's basically the discount we've entered into in these type of tokens, the size of the OTC position. The lockup is actually pretty short. So these tokens, we're not sitting with long tail risk long term, but it's pretty quick deals that can be flipped around, and then that's the current APRs on that portion. Thank you so much for having us, and it's been a pleasure being here. If there's any other questions, feel free to reach out.